Hey, Jonathan, how are you doing?
Doing great, Jimmy. Great to be with you. How are you?
Excellent, excellent. Glad to have you here. I'm doing great. The event's going very well. We've got a lot of attendees here today. So really excited to have you present your Arcturus Impact Investors Fund. So, Jonathan, please take it away.
Great. Well, thanks so much, Jimmy, and great to be here today. Arcturus is a Boston-based impact investment fund manager. We have experience investing in low-income census tracts over 11 years in 6 different institutional investment funds. Even before Opportunity Zones, this was our focus from the standpoint of proprietary deal sourcing and managing our investments going forward. Our OZ platform has currently about $200 million of committed capital. And we recently announced the launch of Fund 6 with a $250 million target. Our investors range from family offices in the $1 to $10 million range, and also plenty of larger institutional investors in the $50 to $70 million range. And today you're going to learn a little bit about a different aspect of Opportunity Zones. Certainly, most everyone's talking about real estate. We focus on investing in private equity operating businesses and also infrastructure. And investing in companies and infrastructure can help us to target higher risk-adjusted returns for our investors. It allows us in many cases to achieve earlier returns of capital and also to deliver additional tax benefits from bonus depreciation. The depreciation benefit is really enhanced on the company side of the equation. And that, again, can be used as a deduction against ordinary income, in addition to all of the customary long-term cap gain benefits that investors are accustomed to getting through Opportunity Zone investments. You'll also learn a little bit about how Arcturus incorporates principal protection partners into our funds. And these include national foundations, cities, counties, states, and federal government partners who provide risk buffers, principal protection guarantees, and last money out capital, all for the benefit of our investors. So I'm going to jump now into a little bit of Arcturus history. I'm going to give a couple examples of OZ deals that we've done, and then also walk through principal protection partnerships, hopefully all while leaving time to do a couple of questions at the end of the day. Certainly, as our 2 board members here, Steve Glickman and Ray Mabus, have pointed out, the Arcturus OZ Fund aims to operate within the 4 corners of the spirit of the Opportunity Zone legislation. We're doing good and we're doing well. We're making investments that create living wage jobs. We're making investments that help communities revitalize. And at the same time, we are delivering above market returns to investors with a lower risk profile than our asset class. As I mentioned, above market returns. We've done this over multiple funds. Another hallmark of Arcturus funds is the principal protection partners. You see some of their logos beneath in this page here. We'll get more into that. And then also community impact. And this really ranges from racial equity focus to low-income communities to systemic poverty in rural areas. Just at a glance here, as I mentioned, we've been investing in underserved communities for 11 years. I came out of a background in technology venture capital, and my partners and I really wanted to create a culture and a firm where you had the same vigor of a venture capital fund, a private equity fund, or a hedge fund. People who are, really driven to succeed and driven to do well. But we've had a unicorn IPO or 2, and now we really want to give back. This is an opportunity not to put up another IPO. The goal is at this point to help fix Detroit, or help bring back Erie, PA, or help promote minority-owned business ownership in places like Cleveland. We have a national investment footprint. We can invest in all 50 states. But we tend to concentrate in states and cities where we have additional principal protection guarantees from our government and foundation partners. 6 active funds, currently more than $30 million. It's actually up to $40 million, and we have quite a bit more committed at this point that will be going into the funds. And these are, again, philanthropic groups that come in and take a higher risk level than all of our other investors, and they also accept a lower return. So high risk, low return, that is a very important foundational element to all of the Arcturus funds, where we have these principal protection partners who are not in it to make an above market return, but they set the table better for all of our other investors. And jumping ahead here, a little timeline on our history. when I started the firm in 2009, we were at the bottom of the great financial crisis. The sky was falling, communities were feeling a lot of pain and stress, and we were able to partner with some of the 2010 Jobs Act programs, which were designed to really stimulate business activity in these low-income areas. And what we were able to demonstrate was that, hey, there's a business in this. Doing impact investing really helps communities, but it doesn't come at the expense of returns. We're able to use these tax benefits, we're able to use these principal protection benefits actually to deliver an above market return to investors. We did 2 funds, national funds that were very similar and increasing in size. And then in 2013, the US Treasury Department came to us and they said, things in Michigan, it's tough in Michigan, and your firm has really done a great job investing in Michigan companies. How about we partner together and start the Arcturus Michigan Fund? And that prototype really became the model for everything that we've done since then. The government came in as a Class B limited partner, meaning last money out of the fund. And then our investors like PNC Bank and Citizens Bank came in as the senior equity. The fund wound up performing great, but if it had not, the fund would have distributed first to our Class A investors, and then there would have been a shortfall left over for the government. It helped us raise the fund. I mean, investing capital for a fund that was investing in Detroit and Pontiac and places that were just coming out of receivership, it would not have been easy to do without that principal protection benefit. But in the end, it helped us all sleep better at night. Certainly, there were times when companies were going through challenges, and it was good to know that principal protection buffer was there if we needed it. 2015, the US Treasury Secretary came out, spent 3 hours with us at our Detroit office, really liked what he saw. We walked him on a factory tour of one of our projects. He saw that 1/3 of the workers there were on a prison day work release program, learning vocational skills so that when they came out of prison, they'd be able to find a better range of job opportunities. He liked it. 2 months later, we start getting calls from Ohio and Oregon and American Samoa and a bunch of different places saying, hey, that Arcturus Michigan Fund model, we're interested in doing it here too. So we did that for Fund 4, Arcturus Impact Fund. And this is still right before OZs. So we did that and again, had principal protection benefits from foundations and government partners who wanted to catalyze our investment activities in specific areas of need. And then when the opportunity zone legislation came through, it was clear to us, hey, we've been investing in these communities for a decade now. We know how to do it. And this tool, the OZ tax incentive, it's better than all the other tools we have in the shed combined. So quickly grew into that, joined EIG Federal Policy Working Group and Technical Corrections Working Group, and became very much involved in helping to make sure that the OZ legislation was A, positive for institutional investors, and B, positive for the communities that we served. And from that, I had a great meeting at the New York Fed right after the legislation. The foundation groups got together and said, hey, we want to make sure that at least a few opportunity zone funds actually do something good for communities. So we're gonna be part of this. Rockefeller Foundation and Kresge Foundation came out of that with a competitive RFP process. They said, we're looking for a fund manager who can use a principal protection guarantee from our foundations to do something that is really exceptional. In their RFP process, they got 161 different applications from groups like Morgan Stanley and PNC Bank and LISC and others. And ultimately, Arcturus was selected. And this principal protection guarantee, it operates across our funds. If we do 30 deals and 29 of them are winners, but deal number 30 gets hit by an asteroid, the good thing is that we have this principal protection guarantee where, because we lost money on one deal, we had a realized loss, the foundations are obligated to reimburse that loss. Right after Kresge came in, the Finance Authority of Maine came in. So Kresge was $15 million. Maine came in with $10 million. And then the process started from there with additional government and foundation partners providing this principal protection guarantee so that we could increase the investments that we were making into their communities. And we actually did an RFP process of our own, and 41 different cities, counties, and states applied for us to come in with those programs where they would provide principal protection guarantees for our investments. We announced Erie just a couple of months ago where we committed $40 million. And later this week, we'll be announcing a partnership with RK Mellon Foundation, which is our anchor for the Pittsburgh program. So Backing up a second, high level, this is a fund with fund level principal protection benefits. So you have these guarantees which kick in case one of our deals go bad. In addition, we have partners who come in with last money out capital, which means they're going to invest in the fund. They get a capped return of 1 or 1.5 or 2%, and their return of capital is contingent upon us. In the most recent deal we did, returning all capital to investors, hitting a 6% pref hurdle, and then they get their capital back. So this is highly favorable for investors, and the foundations are getting exactly what they want too, which is increased investment in underserved, underinvested communities. And all of these principal protection benefits together, there's the risk mitigation aspect, but then there's also the fee side. Sure, we have a 2% management fee on the fund, which is customary in private equity. But then again, we also have some investors who are coming in with 1.5% capped returns. Where does that excess net interest margin go at the end? It's retained by the fund and it's distributed to investors. So the netting of management fee against that incredible subsidy benefit from the foundation and government partners does result in something that's like a zero fee type of fund structure on a net basis, putting those two together. Fortunate to have a great team of people who achieved high levels of career success before deciding that they wanted to commit to impact investing. These are people who ran very large hedge funds, investment bankers, and very large investment managers. We're all very much committed to our dual mission of creating above market returns and also impact. So we've got a very large and diverse team, and our team works based in Boston, but we have people around the country who are focused on the communities that we serve. Exceptional board of advisors too. Steve Glickman, who created Opportunity Zones, Mayor Michael Nutter, former mayor of Philadelphia, who led the U.S. Conference of Mayors and has really been absolutely essential to all of the work that we've done with U.S. cities. Steve Grossman, Massachusetts State Treasurer and current CEO of Harvard Business School's Initiative for a Competitive Intercity. The list goes on, but we're fortunate because of our mission mandate to have a stronger team and a stronger board than we could have ever asked for in a fund this size. So I'd like to jump on a little bit here to make sure we keep in track to, I said I would talk about a couple of deals that we've done recently. We're going to talk quickly about two. One is a good old fashioned operating business, Recaro Automotive. This is a tier 1 seat manufacturer in the automotive industry. They sell to Ford and Porsche and Maserati and a lot of other OEMs. Before we did the deal, it was about a $160 million revenue company, $7 million of trailing EBITDA, nice little middle market manufacturing company. And this was a business that was owned by a publicly traded parent. It was not even located in an opportunity zone. So we wound up buying the company. We moved it into a Detroit opportunity zone, created 150 living wage jobs right out of the gate, qualified it as a new Quas B, qualified opportunity zone business. And then we've got the factory under lease right now. We have an option to buy the factory. We're going to be there for the long term. This is an exceptional example here because this transaction, like many of our business transactions, applies for two different aspects of the tax code. Of course, it's OZ, but it's also QSBS. That's qualified small business stock. 10 years is a long time to ask anyone to part ways with their money. With QSBS, the minimum holding period is 5 years and a day. So at 5 years and a day, if it's a good time to sell an automotive seating company, we would explore selling that company then. It takes away the bigger risk, which is you sit in something for 10 years and year 10 is an awful year for automotive and it's a terrible time to sell a business and then you're stuck in for 15. So, truth be told, we will sell these businesses when it's good to do so. And, there's judgment in that, but we will sell when the market is right to sell. Second example, and this really goes into the income stream and investor liquidity at the bottom, we've done broadband fiber projects throughout the country. These are, again, structured as qualified opportunity zone businesses. But what they do is they own fiber, they install fiber in low-income communities. We've committed to major investments in the state of Colorado and state of Maine. And in these two projects, we own the fiber, we lease the fiber to ISPs and or government municipal partners. and we receive rental income for doing that. There's a principal protection guarantee on the project level as well, and usually some degree of a buyout relationship where we would expect that the ISP or the government would buy the fiber at the end of the term. The reason that these are the perfect tax assets for any opportunity zone, and the reason, I'll just give a quick example. If you look at broadband fiber, it's good for at least 50 years. It's got a very long-term useful life. Fiber lasts, indefinitely. An office building, which we don't invest in, but an office building would be about the same, 50 plus year useful life. An office building is going to be depreciated for tax purposes over 39 years. But the fiber, we depreciate that in year one. The year when that's put into service, we're taking a full 100% tax depreciation benefit out of that investment. So that results in a very large upfront ordinary income tax deduction at the Quas B level that can be passed through the QOF and through to investors through establishment of early basis. And this is what we do. It allows us to provide excess tax deductions on an investor K1, and at the same time, that rental income stream that comes in from the fiber, we're pairing that with depreciation. So on one hand, you've got $1 of ordinary income. On the other, you've got $1 of depreciation tax benefit. Put it together, it's $1 of tax-free yield. And that's really essential to understanding how the Arcturus funds are specifically structured and designed to provide early liquidity, high above market returns, and insulation from both long-term cap gains and ordinary income. As I mentioned, the target size for Fund 6 is $250 million. We just opened it a couple months ago. We have a third raised from our existing investor base, largely institutional. Minimum investment is $1 million. We have a target return of 13 to 15%. Net IRR, that's net of fees. And everybody always asks, oh, is that grossed up for the long-term cap gain exemption at the end of 10 years? No, it's not. You can add on whatever you think the long-term cap gain tax rate will be at that time, and it's the same thing. Investment period is 10 years, but again, the goal here is to pull out a significant capital and give that back to investors. 2% management fee, and the incentive fee is 20% after a 5% hurdle rate. And the members of the firm are significant investors in all of our funds and have a lot of skin in the game. I'm not going to be in a breakout session later. So if this is interesting to you, if you'd like to talk more about OZs or depreciation or impact, we've got an email here, invest@arctaris.com. My personal email is jonathan@arctaris.com, JONATHAN @ARCTARIS.com. And we have a website too. So I hope this was helpful. And if there are any questions and still time to answer them, I'd love to be able to jump in here.
Terrific. Well, thank you, Jonathan. Unfortunately, we don't have time to get to questions today, but if you do have questions for Jonathan, please do email him at those email addresses he just gave, invest@arctaris.com, or you can visit their website at arctaris.com. We did just get one comment that I'll read from Scott really quick. He says, "We need you in Cleveland, Jonathan. Looking forward to Arctaris making positive impact in Cleveland." So
we're there with you, and look forward to seeing you, Scott. Thank you very much.
I appreciate it. Well, thank you, Jonathan. I'm afraid I'm going to have to kick you off stage. We got to move on to our next one. We're running a few minutes behind here, but thank you. I do appreciate you presenting today. Thank you very much.
Thank you.